Good afternoon. This is Greg Kojak. Today is November 7th, 2018. It's the day after the midterm elections. I have a webinar today, and I guess I'll start with the midterm elections. So what happened yesterday was, I guess the best way to put it is expected by the markets. That's why we're seeing a little bit of a bump up today in the performance. And so there is not much that the market was not expecting given the results. So with that, I will keep going with some of the material. Based on the last webinar, I am going to try to condense some of the information and go through it a little more quickly. And so I hope that it suits everyone's needs. But I'm always looking for feedback, so if there's something that I could be doing better, please let me know. Here's our contact information. Again, my name is Greg Kojak from Lincoln Park Financial Group. My direct line is 773-572-6455. Okay, so let's get started. A couple of things that I'm going to cover today is some of the recent market volatility that we've seen, the overall market valuations and kind of specific areas where we're seeing overvaluations, also corporate earnings and profits. On the consumer side, take a look at how the consumer is looking on an overall assets and liabilities standpoint. I also want to cover the Fed, the Federal Reserve, and what it's doing to hold inflation in place. I also have a couple of slides that are pretty interesting that go through the kind of the breakdown of how a recession develops. On the international side, go through some of the things that we're seeing on the international and outside of the U.S. Company side, and it's directly correlated to a strong U.S. dollar and tariffs. And that's about it for today. So I'll just keep going and start here. So here's my slide for the S&P 500 intra-year declines given calendar years. So we're going to go back to probably about 1980. And you can see based on the chart that despite average intra-year drops of 13.8%, annual returns are positive in 29 of 38 years. So what that's telling us is the buy and hold strategy works. So if you bought into the S&P 500 each one of these years and you held, meaning you didn't go to cash, you didn't sell anywhere intra-year, you would have enjoyed these pure rates of returns. Given that particular year. However, you also had to have endured this kind of a intra-year decline on the low side, the negative numbers in the red, in order to get a positive rate of return. So again, reinforces buy and hold. The one takeaway and pointer I want to show everyone here is that 13.8%, I drew a line roughly where that is. And you can see that given the past few years, we haven't really seen that. We're almost getting close to touching the average of 13.8%. However, we really haven't seen that yet. And so I want to keep that in perspective because some people are confused about the markets, worried, is it doom and gloom? Is it time to get out? And the answer is no. This is normal volatility. It's just that we have not seen it very much in the last probably 1, 2, 3, 4, 5, 6, 7 years plus. And so anticipate more volatility because it is a kind of a new beginning to the markets as we get out of easy liquidity and what the results of quantitative easing. Okay, moving on to valuations. Obviously, we want to take a look at valuations. This is a chart that shows that S&P 500 on a forward PE ratio to give a perspective going back to 1990. The pointers here and takeaways are the 25-year average is 16.1%. I added a little bit extra information on here because it gets a little complicated with dual slides and it gets small print. But you can see at the end of September 2018, the PE ratio was at 16.8. So at 16.8, it was just barely above that 25-year average, meaning the markets are not overvalued at that point, maybe slightly. And with all the activity that we had in October, the markets had a pretty significant decline quickly. We're now at an even more attractive 15.5 PE ratio, which is even further below that 25-year average. So if you're looking at valuations and thinking markets are overvalued based on the statistics of a 25-year average, the answer is no. Okay, moving on. But of course, there are different valuations and segments of the market. So this slide kind of breaks it down onto the level that we take a look at with our portfolios. We have the value portion over here. We have the blend, which is kind of the middle point, and then growth. So examples here, value companies would be something like an oil company, where a large oil company only explores, pulls oil out, refines it, and sells it, right? They're not developing new gadgets and widgets and selling goods and services. So on the growth side, it's a totally different concept here, where these growth companies are going to their consumer in the consumer base and saying, what would you like to see from us with new products or new services? And when they do their research and development, they'll get an answer and then develop the product to ultimately sell it. I would, not in all cases, but I will probably say as a blanket statement, value companies tend to pay higher dividends. Growth companies do not, because they're spending that money creating more research and development. And then, of course, you've got your large, mid-size, and small companies. So what we're seeing here, I'm going to jump over to the bottom right-hand corner with current PE ratios as a percentage of a 20-year average. I also added 9/30 data just to show you what happened and how much it affected in October. So it was large cap growth, if you follow this, was 107.9%. Its current PE ratio over its 20-year average back on 9/30. This is data as of October 30th. And so that percentage has dropped to 97.3. So we've had about a 10% sell-off almost uniformly on the growth side, a little bit less in the mids. But all in all, we did see some overvaluation on the growth side, only because growth in tech has done so fantastically well that at some point it had to give back a little bit. It doesn't mean that it's necessarily time to get out completely. However, we are strategically making some moves, as we've done previously over the past probably 6 months, to move away from the growth side, because we did see these overvaluations, specifically in small growth. And we are trending over to the value side, where we see more attractive valuations to go in at a, I'll call it a sale price. Okay, so we want to talk about corporate profits as well, because they drive stock prices and company stocks. So here, S&P 500 earnings per share, we can kind of see the trend, and the trend has gone obviously since 2000 and roughly mid-15. Corporate earnings are fantastic. They keep growing. Earnings per share keep growing. These are all kind of in the books. In the green, these are the analyst estimates going into the end of 2018 and also 2019, which my arrow shows a little bit of a slight plateau in the middle of 2019. But clearly, we're not seeing anything that would indicate a severe drop-off in earnings. If you did, that would obviously affect stock prices. And then over here, we're also studying the profit margins. This is, again, S&P 500 numbers. So these are quarterly operating earnings per share for these 500 companies in America. And you can see, again, plateau a little bit through 2012, 14, 15, and then they kind of increased. So we're seeing profit margins of these corporations at all-time highs at 11.9%. Again, it doesn't show us anything that we're seeing a drop-off, or we might go through another plateau period, as we've kind of seen in the past. That doesn't mean that prices will decline severely and sharply, and therefore might be time to reposition our portfolios for our clients. Okay, so the other part of the economy is studying the consumer. So the consumer obviously is driving a lot of these corporate earnings by spending for pleasure, new devices, new smartphones, new technology, or cyclicals, redesigning and rehabbing their home, buying new cars, that type of thing. So when we look at the consumer balance sheet, this is, again, kind of breaking down the consumer, you and I, probably on a fundamental level. And what we can see is all of the assets lumped together. So our homes, our different deposits in banks, our retirement accounts, and other financial assets. Over here on the right, we get to see all of our liabilities. And our liabilities, the largest portion, 66%, make up mortgages. And then here's a breakdown of the rest of it as it relates to our overall liabilities. What we can see here is obviously total assets, total liabilities. We're looking at roughly about 12% that the consumer keeps on hand in debt versus total assets. And then over here, the chart on the right will show you what the household debt service ratio is. It's a little bit different where it talks about its debt payments as a percentage of disposable personal income. So we can see that it did get to an all-time high back in the fourth quarter of 2007, right before the Great Recession. And then there was a pretty quick and steep deleveraging period. But ever since then, we have held our debt service ratio to a very, very low and comfortable level. And if you back it up, this 9.9% level that we've seen in the third quarter of 2018, again, is the best we've ever seen. And that even goes back to the early 2000s, the 90s, and even the late 80s. So the consumer, from what we're seeing, is in good shape. Next, I want to talk about the Federal Reserve and what they're doing and how they're operating, because not a lot of people understand the mechanics behind what they're doing. I will say that their ultimate goal, I believe, is to hold inflation at as low of a level as possible, but yet make sure that wage increases are happening. So as the consumer is going through the expansion period, they're making sure that wages are keeping up with inflation. So I've kind of identified this and broken it down into a couple of different segments. So here are the Fed funds, everything that's happened throughout the years and how they've been kind of stepping it up here through the early 2015 portion, 16 and 17, and as they keep going up. So the blue diamonds are kind of where the Federal Open Market Committee is telling us that the Fed funds rates will go based on what they're seeing. They do make adjustments here or there where they see either the GDP or unemployment or inflation ticking up. So they obviously have room to maneuver. However, they also point out they want roughly a 3.00 a long-run projection for the Fed funds rate. So we're almost there. You can see based on what they're telling us. Here's the market expectation. So these are options on the, I believe it's the 10-year Treasury, and how it's getting to this long-term mark. What's interesting is, again, if you look at what their ultimate goal is, number 3, they want to hold inflation as close to the 2.0 mark as possible. Because if you let inflation run and get out of control, it really causes a lot of havoc on economies. So 2.1, 2.0, 2.1, 2.1, 2.0 is that long-term run. But what's interesting is during this process that they're raising Fed rates, what they're doing is tapping on the economic brakes of the U.S. economy. Essentially, they don't want it to get too overheated, is probably the term that I'd use. And so with a 3.1 projected GDP, and it's about that for the year over year for this year. They do expect it to kind of taper off and slow down because they are planning on, again, fulfilling their projections and what they're saying to get to a 3.0 long-term run average for the Fed funds rate. So, yeah, you will see the GDP start to slow down, and their long-run GDP projection is 1.8. What happens when you slow the GDP down of the United States? Your unemployment rate starts to creep up. So they don't project that it will in the near term. The near term, they're kind of positioning out the next 2 or 3 years. They think it will go down even further, down to 3.5%. And 2020 roughly is what their projections show to creep up. But they do see a long-run unemployment rate that's sustainable and healthy for the economy at 4.5. So when you do the math, that's roughly a full percentage point. And a full percentage point on the U.S. workforce is, I believe, over 1 million people. And with over 1 million people unemployed, what's happening is the people that are out of work are fighting for the jobs and the positions of people that are already employed. That happens because they want to keep inflation in place. So with a very tight labor force, skilled people are a rare find. And when they are found, employers are giving incentive packages and options and additional compensation, anything they can to attract new talent. And so that's where compensations, salaries, bonuses, incentives go up. And so those things cost corporations money. When those corporations are incurring more expense to get and retain these people, the people that are required to get this company going and grow, the company has to raise its prices on goods and services. So multiply that across the United States, almost all sectors, almost all industries. So if everybody is kind of increasing their prices, that's where inflation comes into place. So again, trying to slow the economy down will increase unemployment, which will ultimately hold inflation in place, which is what the ultimate goal of the Federal Reserve is. Okay, so we do see inflation creeping up, and we can tell because there was little to no inflation. There was some deflation actually going back to 2015. And we can tell that inflation is crept up also because commodities have started moving in terms of their prices. So we can track the commodity prices of just a handful here. These are based on Z-scores, and Z-scores are the 10-year average of certain commodities. And so you can see the breakdown of agriculture, livestock, silver, industrial metals, gold, natural gas, and crude oil. And this down here is the legend to show you that when the blue diamond is to the right of 0, which is the Z-score, commodity prices are historically on a 10-year basis higher than they have been, and when it's to the left, it's lower. So I added a little bit of extra data and shown that the red dots are actually going back to August of 2018, and the blue dots show where they are currently. So we can see that those blue diamonds are starting to move closer to the Z-score, indicating that commodity prices are increasing as a result of inflation. So we are currently adding commodity exposure to our portfolios also to offset some of these inflationary pressures. So, but I will tell you that it's been a long, long time since we've had any commodity exposure, just based on the fact that there's been little to no inflation in this economic expansion for roughly, and I'm not going to say exactly, but I would say probably about 5 or 6 years. All right. So now I want to go through a couple of slides and talk about what else we're seeing and how we're interpreting the data that we're seeing. So the next couple of slides will talk about noise versus signal, and this has to do with the economy and where we're at in an expansionary period. The point of this slide is that right here, over the past 37 years, only one market crash hasn't been accompanied by a recession. And so if you think about that conceptually, if we're worried about a market crash, we should also take a look at if we're heading into a recession. And if we are, maybe we should be getting prepared, because obviously there's a lot of correlation as a result of that. So fast forward, we're going to go to the next slide. These are 12 variables that have historically foreshadowed a recession. They're U.S. recession risk indicators, and we're looking at the past 2 quarters of U.S. economic data. There's more, but in general, we're looking on the financial side for yield curve, credit spreads, money supply, inflation. We're looking at wage growth, commodities. And then on the consumer side, housing permits, jobless claims, retail sales, and job sentiment. And on the business activity side, new orders, profit margins, and truck shipments. So we can see in the second quarter, we had one signal flash of caution, which was profit margins. So corporate profit margins dipped just slightly. They've since reverted to, kind of the positive economic level. In the third quarter, though, we saw money supply, which is a result of the quantitative tightening. So the money supply is getting pulled back in, meaning there's less liquidity out in the economy. And so that has flashed just as a cautionary signal. So we can see here, we're in the economy, and what it's showing right now is that it's in good shape. We might see something here or there, but let's take a look at how the current, where we're at with the U.S. economy currently is how it compares to past recessions. So again, we have 12 different variables, the same ones that we just saw on the previous slide. Here's the current cycle of the U.S. economy, but now we get to show and compare it to the 2008 Great Recession. Before that, the 2000-2001 tech bubble, and 1990, 1980, 81, 82, here's 80, 73 to 75, 69 to 70. So these are all recessions, previous recessions that happened in the U.S. economy. And pretty easy and clearly, I think, based on the slide and what it's showing, is that the current cycle is not flashing anything close to what the previous recessions have shown. So going backwards, we can see a lot of reds, which is, full signal recession, and then also a lot of yellow cautions, meaning, it's turning in a direction that would indicate a future recession. So this is interesting, and a lot of questions that develop around this is, well, how fast does this happen? Is this an overnight? Is this, 1 week? How fast does this all unfold? So that's the next slide. We can look at a case study. This is the most recent one, the Great Recession going back to 2008, and our recession dashboard. So it starts in the second quarter of 2006 and ends in the second quarter of 2008. And the recession officially started roughly the fourth quarter of 2007. So here, again, is the S&P 500. It's different levels, but here are those 12 economic signals. And studying them, you can see, where they left in 2006 in the second quarter. We've got 1, 2, 3, 4 cautions. We've got 1, 2, 3, 4, 5 greens, and then only 2 recession indicators. Move over to the fourth quarter of 2006. We're seeing more yellow, more red, fewer green. Second quarter of 2007. More yellow, more red, fewer green. Fourth quarter of 2007, again, the official start of the recession, it's almost all red, a couple of yellows in jobless claims and truck shipments, and eventually in the second quarter of 2008, we see the whole aftermath, and it's full-blown recession with truck shipments. So obviously this takes a little while to develop. And obviously, if you're watching and studying these signals, you can have a heads up that something might be on the horizon. So, which is exactly what we have and what we're doing currently. Okay, so finally, an explanation for some of the increased volatility. A lot of it has actually happened internationally outside of the U.S. We've seen the volatility here in the U.S. in the month of October, but we also want to point out that it's kind of wreaking havoc. What we're doing in the United States is wreaking havoc outside of our country. It's through tariffs, and it's also because of the strong U.S. dollar. It's our tax reform that's boosting the U.S. dollar. So the things that we're doing is kind of helping the U.S. economy, but at the same time, it's making foreign companies that are buying U.S. goods and services, those companies are struggling because their costs are going up. And so on the international side, if you haven't been paying attention, some of the emerging markets have been hurt the worst. Don't quote me, but I would say somewhere in the 15, 16, 17% range that they've declined over the past couple months. On the developed side, which is, I would point to the European Union. They're also not immune to it because they're buying U.S. goods and services. And so they're down not as much, but I would say somewhere in the 10, 11, 12% range over the past few months. What's interesting, though, is, again, if you take a look at valuations, here, the blue diamonds and where they fall below kind of the 25-year mark, which is this kind of purple band, you can see the U.S. is roughly right there in place for that 25-year average, not overvalued, slightly undervalued, but take a look at the developed markets, Europe specifically, Japan, and the emerging markets. They are undervalued. And so a lot of people are pointing to that and saying it's a good time, the valuations are great, and it really could be a good time to invest over a long period of time. We just don't know what's going to be the result of these tariffs. They could be another year or two, as you can certainly read about. Some people are saying the administration wants to finish them off and get a deal done as soon as possible. That can certainly happen. So it really depends on what happens with those tariffs, which will impact the rest of the globe. And the rest of the globe, if you're investing outside of the U.S., will really impact what you should be doing and how you should be allocating, because it's also kind of a different stretch that you should be prepared for in a time horizon for which you should have expectations set for your international allocations. All right, so I wanted to keep it relatively short and sweet. So that concludes today's webinar. I didn't touch on all the topics that I've done previously, but I will, and I'll continue to build this. So again, my name is Greg Kojak. My firm is Lincoln Park Financial Group. And thank you for watching today's webinar, and please check back for the latest updates, and have a great week.